Hello and welcome to the Global View, the show where we look at ways for investors to make money beyond the ASX-listed universe. I'm your host, Juliette Sarli. Well, it was record number 42 of the year for the S&P 500, US stocks notching up another win as traders await fresh clues on the health of the economy following upbeat data released Thursday. The S&P 500 climbed by 0.4%. The Nasdaq was up by as much as 1.5% during the session before closing higher by around half that, and the Dow Jones index edged higher by 0.6%. The Russell 2000 index tracking small caps outperformed the broader market. Chipmaker Micron Technology shares jumped 15% after the memory chipmaker projected first quarter revenue above expectations, highlighting strong demand for memory chips used in artificial intelligence computing. The broader Philadelphia Semiconductor Index was up by almost 4% as most chip stocks rallied in enthusiasm. China's stimulus plans boosted metal stocks, with copper miner Freeport-McMoRan up by 7.5% and lithium miners including Albemarle and Arcadium up close to 10%. However, energy stocks lost around 2%, tracking crude prices that slid on expectations of greater supply by OPEC. Chinese listed shares of Alibaba were up more than 10%. In the financial space, Wells Fargo gained more than 5% after a report showed the banking giant had sent the Fed a review for lifting asset cap restrictions. And Accenture rose 5.5% after the IT services provider forecast annual revenue above estimates. In economic data, the number of Americans filing new applications for unemployment benefits dropped to a 4-month low. Weekly jobless claims fell 4,000 to 218,000 last week, the lowest since mid-May. Now that suggests the labour market remains fairly healthy. The upbeat outlook on the economy underscored by other data showing corporate profits increased at a more robust pace than initially thought in the second quarter. US Treasury yields edged higher after the data, which led traders to cut bets that the Fed will make another 50 basis point cut at its November meeting. The dollar index fell, on track for its 6th drop in 7 sessions. Our dollar still holding around 18-month highs against the greenback. For more on what is moving markets, I spoke to Carl Tannenbaum, Chief Economist at Northern Trust.
Well, it's just my luck that the interest rate differential between Australia and the United States would start to increase shortly before I'm making my annual visit to your part of the world. The US dollar has lost some of its ground as a result of those changes, but my travel schedule is not a consideration for central banks. Each of them, of course, is reacting to the growth and inflation dynamics in their particular markets. Here in my country, the Federal Reserve quite clearly has gotten a lot more confident about inflation converging to the target level, and on the other side of its mandate, getting a little bit more concerned about the potential that unemployment, which has been up slightly, could go up further. That led to a large increase from the Fed, which we don't think is going to be repeated, but they will probably be on a path to get to their neutral level, around 3% or so over the next 12 to 16 months. By contrast, in places like Australia, where inflation is still an issue, the RBA does not feel to us like they're going to be ready to reduce interest rates during the course of 2024. Europe somewhere in the middle, trying to deal with an economy that is probably slower, quite a bit slower than it is at least here in the United States, and yet there's still some lingering wage and inflation pressures that have to be respected. So it's quite a change from where we were a year ago when all the world central banks seemed to be comfortably on hold to fight inflation. Now for investors, trying to figure out the sequencing is really the key.
Absolutely. And of course, the key is the path forward and the forward guidance as well. You mentioned there that you don't think potentially follow-up of a jumbo cut, but how are you tracking the overall US economy? We just saw the unemployment benefits number at a 4-month low.
Well, it did surprise me. I'll be very honest that the Fed went by 0.5% last week. We just got updated growth numbers in this country for the second quarter. It was at 3% pace adjusted for inflation. The tracking for the current quarter, which will end at the end of the week, is also at 3%. And you would think, well, boy, that's pretty robust. What is the downside risk? I think the issue is that we have seen job openings come down. And when that crosses a level that's equal to the people looking for work, that often in the past has been a trigger for unemployment rising much more rapidly. So again, in the balance of risks, that seemed to be what won the day in Washington last week. But I don't think that they'll, and the chairman was very careful in his press conference to say, this isn't an emergency and don't expect us to act as if it were.
Let's talk about the impact to markets, though, Carl. A 42nd record of the year for the S&P 500, and this is being boosted by, whether or not you want to continue saying the jumbo cut from last week, but also China's stimulus efforts. You look at the likes of Alibaba shares in the US up some 10% during Thursday's session. What are you seeing in the overall market momentum?
From a fundamental perspective, at least in the United States, we're getting very, very close to that soft landing that we've been seeking for more than 2 years. That is a scenario which the markets should adore. It's one where growth continues at a healthy pace, one where borrowing costs come down, and where inflation is less of a risk. China, however, is not having as strong a go of it. In fact, I think the concession on party officials earlier this week that their economy was facing risks is what led them to a broad package of stimulus. Now, the main reason why it has boosted Chinese equities is that part of the stimulus was giving money to securities brokers and essentially telling them to buy stocks. Now, that is obviously a recipe for higher prices, but is it really creating value? Is it really going to address some of the fundamental imbalances that China has? Their consumers have been very inactive. Their savings rates high, their export markets being a little bit more constrained because of security reasons and resilience reasons. They have producer deflation that's been ongoing for a while and consumer inflation that's barely positive. Really, to be lasting, what I've been thinking and saying is that China needs to do more of a demand side stimulus, getting spending back on the track that it was prior to the pandemic. And that should allow the economic cycle to work well on its own without needing artificial support.
Do you think that it is likely we are going to see some more support, though, from Chinese officials?
Inevitably, I think they will have to continue to find ways to stimulate their economy. Their measures this week did, again, take another stab at dealing with a property market overhang, which could take a very, very long time to work out from under. It involves not just the developers and the banks that finance some of those developments, but also households who put down payments and in some cases took out mortgages on properties that are vacant or may never be finished. So the hole there, no pun intended, is one that's relatively large, and Chinese officials will have to manage not just the financial aspects of it, but also the psychological aspects.
Carl, let's talk about migration as well as an economic challenge, but I guess opportunity as well around the world. What are you seeing in terms of trends? Here in Australia, we do have migration pushing up the housing shortage, but at the same time providing a lot more support to the economy in terms of jobs as well. How do you view the overall migration picture?
Well, you're having the same debate that they're having in Canada, that they're having in Europe, and that we're having here in the United States. Are you aware that we're going to have an election in a few weeks? And this is one of the real central issues, not just economically, but socially. In a nutshell, countries that are developed usually have relatively modest rates of birth, and our demographics from a native population aspect are not encouraging. We're doing well just to keep up with the death rate, if you want to put it that way. And so immigration for our two countries, as well as others, has long been a formula for sustaining labor supply. And the data show us that many immigrants come in and they are very innovative. They invent things. They start companies that really add to the productivity and growth trajectory of our countries. But I don't think anybody would suggest that having wide open borders and unfettered migration is a wise policy either. That strains the ability to assimilate and to find matching in the job market. And also the housing issues that you're dealing with, and certainly that's also acute in Canada, need to be managed in a way that's consistent with a steady flow of immigration. So it's a hard set of choices, given that a lot of people want to come to our countries, given faltering prospect elsewhere, and it's going to require constant political care and economic focus.
Now, Carl, we have heard that there is an election happening in November in the US. That news has made it down under. Just tell us more broadly, I guess, what we can expect in terms of geopolitical risk in the lead up to this hotly anticipated election.
So, among the few things that the two leading candidates agree on is that trade is not always desirable, and I doubt very much that tariffs are going to be reduced in the wake of the election, no matter who wins. Of course, former President Trump has promised much higher tariffs, and that certainly would roil the trade markets around the world. There is evidence that the weakening of the global economic order is having a mirror effect on global diplomacy. Measures of global trade have declined at the same time that measures of geopolitical risk have risen. This global order, which started in the early 1980s and lasted right up until the global financial crisis, helped keep the peace, but now countries seem a little bit more hesitant to intervene or help keep rogue actors or movements from winning the day. The two wars that we have going on at the moment are very unfortunate. The humanitarian costs are immense. And the roots of each of them go back centuries in some cases. But the fact that they broke out now, I think, is attributable in part to the fact that nations are looking inward and not outward and allowing the space for some of those, what's the best word for it, those bad actors to step forward.
All right, Northern Trust Chief Economist Carl Tannenbaum joining us there. Just before we go, getting a quick check on where the local market is set to open in 4 minutes' time, a gain of around 0.25%. So adding to yesterday's healthy gains, we are going to bring all of that to you in the open. We also have a deluge of listed real estate investment trusts trading ex-dividend and Chinese industrial profits scheduled. But that does it for this edition of the Global View. Stick around, the open coming up next.